On every explosive move the market makes, there's one candle that started it all, and almost nobody notices it. It's usually small, it's usually pointing the wrong way, and it's exactly where the biggest players in the market place their orders. It's called the order block, and once you can spot it, you'll know where smart money is waiting to buy before price ever gets there. Let me show you what it is, why it works, and how to trade it. So, here's the pattern. And it sounds almost too simple. A bullish order block is the last red candle before a strong move up. That's it. That's the definition. Picture a market drifting downward. Red candle, red candle, red candle. And then one final red candle. Nothing special about it. And then ignition. A massive green candle erupts out of it. Then another, and price rockets up and breaks above the recent highs. That one last red candle, the little one everyone forgets about the moment the rocket leaves, that's the order block. And marking it couldn't be simpler. Draw a box around that whole candle from the top of its wick to the bottom of its wick and stretch the box out to the right. That zone is about to matter. Okay, so why would one boring red candle be so important? Think about what smart money actually deals with: size. A big institution can't just buy everything it wants in one click. An order that size would launch the price instantly, and they'd end up paying more with every second. So they buy while the market is still falling, quietly, inside those final red candles, soaking up everything sellers throw at them. That last red candle is the exact footprint of where they finished loading up. And here's the key. They almost never get their entire position filled there. Some of their orders are still sitting in that zone. Unfilled. Waiting. So when price comes back down to it, those leftover orders are still there to buy again. That's why the zone works. It's not magic. It's unfinished business. And that gives you the whole trade. The move already left, but the launch pad remains. Sooner or later, price often comes back to retest it. Traders call it the return to the order block, and when it arrives, the same players who caused the explosion defend their zone. Price dips in, gets swallowed by those waiting orders, and launches again. Sound familiar? It's the same story as the fair value gap. Smart money leaves a footprint, and price comes back to it. So here's the plan. 3 simple steps. Step 1, find and mark the block. After a strong move up that breaks a recent high, scroll back and find the last red candle before it. Box up the entire candle, wick to wick, and extend that box to the right. Then comes the hardest part, doing nothing. You don't chase the move that already left. You wait for the return. Step 2, your entry. Price drifts back down and touches the top of the box. That's your first possible entry, right at the edge of the zone. But if you want a more precise trigger, be patient and let price sink to the middle of the candle, the halfway point of the block, which in smart money language is called the mean threshold. It's the exact same idea as the midline of a fair value gap. Once price is halfway in, the zone has been properly tested, so keep it simple. The box is your zone, and the middle of the candle is your trigger. Step 3, your stop and your target. The stop goes just below the bottom of the block, right under that candle's low. The logic is brutal and clean. If price cuts through the entire order block and keeps falling, smart money isn't defending it anymore. The idea is dead. Get out small. And your target? Look up. Aim for the high that the explosive move created, or the next obvious level above it. You're risking the height of one small candle to catch a move several times that size. And that's the kind of math that keeps traders alive. Now, the honest part. Because most candles that look like order blocks are worthless. So here are the 4 quality filters I'd check every single time. First, displacement. The move leaving the block has to be violent. A huge candle. A clean break of a recent high. If there's no explosion, there's no order block. Second, the gap check. The very best order blocks launch so hard, they leave a fair value gap right next to them. That's institutional urgency printed on the chart. Third, freshness. The first return to the block is the one that counts. A zone that's already been tested 2 or 3 times is running on empty. And fourth, my favorite, the sweep. If that last red candle also dipped below an old low first, grabbing everyone's stop losses right before the launch, that's the highest probability order block in the game. Sweep, block, explosion. Smart money's full signature. Okay, now flip everything for the bearish version, a market grinding upward and the last green candle before a violent collapse. That's a bearish order block. Sellers loaded up inside it. Box up that candle, wait for price to rally back into the zone, enter at the edge or at the middle of the candle, put your stop just above the block, and target the low the collapse created. Same footprint, upside down. One final weapon, the breaker block. Sometimes the zone doesn't hold. Price slices straight through the order block and closes beyond it. Dead trade? No. Transform trade. A broken bullish block flips into a bearish zone. When price rallies back up into it from below, the trapped buyers who bought there are desperate to escape at break even, and their selling turns the old support into fresh resistance. Failed block, flipped block. Your next trade pointed the other way. Exactly like the inverted fair value gap. So there it is, the order block, the last candle against the move, hiding the biggest orders in the market. Find the ignition, box up that candle wick to wick, wait for the return, and trade it with the middle as your trigger, your stop past the block, and the high as your target. One boring red candle. And now you know exactly what it's hiding. I'll see you in the next lesson.